2, that one over my expectation. So actually, I think it's still okay lah. At the end, I think the score A1 also 20-30% we achieved. Okay, because actually the first 2 classes really, I do not know why the mistake from the calculation causing them losing a lot of marks. But you shall be thankful to them also, because actually I remarked, because the first 2 classes I marked, I feel that relatively low, the marks only 60. So I remark, especially on the relevance I remark all these relevance, the variations business variation relevance on that, the 4 methods. Initially, I'm a little bit stringent lah. I want you all to include your own justification, and after that, you can see when you get back, I just give 3, 3, 3, 3, 3, 3, 3, 3, 3, all give you full marks. You should be thankful to them also, because must be standardized. If I change, then everyone will be the same. Okay, we come back to here first. Later we only talk about the midterm. I think your group also, I think 30%, is it 30 something percent of students score A, so I think it's not that hard lah actually. Never mind, we will go through this one first. All right, for today, very quick revision. Today will be quick one, because actually this chapter, risk and uncertainty, the last week chapter, there isn't much new things lah, I would say. Okay, basically you just need to understand, it's still under MPV, we are still under MPV, and this one is talking about the risk and uncertainty in the MPV, because as you know, the formula of MPV, sum of all the future cash flow divided by 1 plus R, right? Okay, this one is a formula. And every time when we write like year 1 the cash flow, year 2 cash flow, year 3 cash flow, these cash flows, I think all of you know, is what we call expected cash flows. Okay, when we call them expected, it means that they haven't happened, and there will be a risk that what you have expected and the actual outcomes, or what we call actual cash flow, that what really happens it could be different one. Because if I draw that in a timeline, you always see something like that, is that? So we evaluate a project. Definitely the project will be giving us future cash inflow lah. We pay some money today, and then at 1 year later we get like 80,000. 2 years later get like 100,000. From there we calculate the MPV, right? We convert everything back to a present value. And here, this chapter you need to understand, all of these, year 1, year 2, year 3, year 4, they are expected cash flows. It means they are only estimations. It's only something that we think most probably is going to happen, this cash flow. Okay, then we will record 80,000 1 year later. But at the end of the day, as you know, the actual outcome, it could be 50,000. It could be a different one, because it's only an expectation. Now, something in the future, we cannot guarantee that it will happen for sure. It's only based on our estimation. And this risk is so important, because as you know, like the NPV that you have calculated, initially at year 0 right now, we based on future cash flow, we calculate the NPV. Based on all the future cash flows we calculate, it could be a positive figure. But you try to ask yourself, if in the future, what you have expected and what, difference from the actual outcomes, then maybe this project actually is not profitable. So this one is the risk lah. And today we are going to talk about that. Okay, so we have many methods to actually measure the risk, or to even incorporate the risk into the MPV method. All right, and I have listed down all of them. Okay, just a quick one. I will only focus on this one, to be frank. Okay, because when it comes to exam, usually the method that involves calculation is this sensitivity analysis. You can say that it's the most important one, because it involves calculations. While the others, I'm not saying they're not important, but the others usually that will just ask you in theory based. Maybe the question will be asking you to calculate by using sensitivity analysis. And then the theory question will ask you, so other than sensitivity analysis, what are the other methods that are suitable to incorporate the risk into the MPV, something like that. So you also need to know. Okay, so a quick one. Let's talk about the sensitivity analysis first. This one. I think I need to mute my phone first. Okay. All right. As you can see, okay, sensitivity analysis in terms of calculation is pretty simple. The formula, it is just NPV, net presence value of the project, divided by presence value of the variable. Okay, the variable here will be any items before the NPV, or sometimes we call it input. Okay, because all of these, like the highlighted one, all of them are variables or inputs. If they change, if you have an impact on the output or the bottom line NPV. So it's basically we are just using the NPV divided by present value for each of them. Okay, like this cash from sales. This one is maybe the cash from sales usually is like year 1, year 2, year 3, year 4. Year 1 20, year 3, year 2 30, year 4 40, something like that. So all the cash flows that from the variable, we convert them to a present value, which is this figure. What I mean is like usually it won't be one figure one. It's year 1, year 2, year 3, something like that one. Then you have this cash from sales from the question. Or when you are calculating the NPV, you will include like 30, 40, 40. All right. So if in the exam, if the questions wants you to calculate the sensitivity of this variable, you need to convert all the 3 cash flows here back to the present value. Very simple. Following the same discount factor, how many percent, I do not know how many percent from the question 1. Then you change them all to present value. And when you add everything up, we assume it's 100 here. That's how you get the present value for each variable. Can understand? So we just use the NPV. Here is 10 divided by the present value of this variable. So it's 10%. Calculation, no problem. Very simple. And remember, the lower the percentage of this sensitivity, the more sensitive on the impact of changes of this output to the of this input or this variable to the output. Because you may ask, what does this 10% means? This 10% means if this variable is this one is a cash inflow, if this variable drops 10%, your NPV will jadi kosong, will become 0. Because you see, if it drops 10%, it means 90 lah. And you see, if you become 0, can see that okay? So which means the smaller the percentage, the more sensitive, and which means that this variable is more risky. You can think like that. This one is the riskiest one among the 3, because only 10% change if you make your NPV to become 0. It also means that if this number drops more than 10%, what happened to your NPV? Negative. Okay, if like drops 11%, then you can see your NPV negative. Why do we calculate that? Because like what I said, all of these we are getting them from the expectations, from the future. What happened, then we calculate. Okay, so this one risk will be there one. It could be different one at the end. So this figure is telling you this one cannot difference more than 10%. If you difference more than 10%, initially it's a good project but if at the end difference is more than 10%, this one will no longer profitable. Okay, so the smaller the percentage, the more sensitive on the impact of changes, okay, of this variable to the output. Or put it simple, it is riskier. It's more risky. The smaller the amount, it means that it's very risky. If you are talking about like 1%, if this one 1%, is very, very, very risky. Because any 1% change the actual outcome difference only 1% from what you have expected, your NPV jadi kosong. If more than 1%, this one will be negative. Okay, that's how you explain. If the cash inflow you need to explain is drops, drops how many percent? Cash outflow will be increased. Alright, I give you 1 minute. Any question you can ask me? Very simple calculation actually. It's not hard at all. So this method basically just to tell you from the sensitivity analysis you will know which one is the riskiest one. And if you know that this one is the most sensitive one, like in this case, then which means that when it comes to monitoring, when you are implementing the project, when it comes to monitoring, you must make sure whatever you have expected earlier, you must make sure, realistically, it happens like what you have expected, because you know that this one you cannot afford to have a huge difference with the actual outcome. So you know this one better make sure whatever you have expected, the actual outcome similar, okay, cannot have a huge difference. Okay, 1 minute for this one. Okay, like what I say, this one, if you ask me, from this chapter is the most important one, because if you look at the past year, always, sometimes you will see this one, sensitivity analysis. All right, then after that we have, other than that will be quick one. I just theory only. Probability analysis will be something like this. I've already explained. Okay, because usually our future cash flow, the most basic one is just we estimate what figures, we have the highest chances to happen. Like in this case, sometimes our year one, this one is NPV. NPV also can. So we will just based on what is expected to happen, then like 500 most likely to happen one, then we just record 500. But if you want to do it better, we can perform probability analysis. So probability analysis basically is just we will be allocating different probabilities for different scenario. Like in this case, we will have like, if the economy is normal, okay, nothing much happens, which is most likely to happen. Probability 0.6 or 60%, it means that 60% chances that this one will happen. And when this happens, when the economy is normal, nothing happen, okay, then the NPV will be 500. All right. But we also allocate that maybe we have 20%. Okay. The economy will be booming. Booming, it means they're very good. So if the economy is very good, we can get 1,000. If the economy is very bad, bear market, then we can only get 100. All right. So our NPV, you can see when we calculate the NPV, is no longer we just take that most likely to happen 500, so we assume 500. No, we will times the probability, like 1,000 times 0.2 and then 500 times 0.6 and so on. And we will combine them and we will get what we call expected net present value 520. And this one is deemed to be a better one, NPV, because this one is kind of like we have already considered all the possibilities. Like if the economy is booming, normal, bear market, we have already considered that. And this NPV is kind of like an average NPV, from all the scenarios. Okay, this is probability analysis. And then we have certainty approach. Okay, certainty approach, very simple one. Certainty approach is just something like we change everything to riskless. Okay, zero risk. Okay, the way will be something like for example, actually year one you expect to receive 80,000, but again, because future cash flow expected it's only an estimation, might not be a accurate one. So usually cash inflow that will lower down. So maybe we minus 10k we only record 70k. Why do we do that? Because 70k is considered as riskless already. But you reduce berapa, that one subjective, is the weakness of this approach. But if you reduce the cash inflow item, initially we record 80, now we record only 70. Because the 10,000, we kind of like sacrifice the 10,000, and then for the risk purpose, we have already considered the risk, so we only record 70,000, not 80. We call it certainty approach. Okay, Monte Carlo simulation, I have explained that in the lecture class already. It's kind of like just we keep on simulate. It means that we keep on attempts doing the same events, and based on the law of large number, when you have tried enough time, like 1 million times of the same event, you tried 1 million times, then you kind of know already what will be the outcome for this possibility, what will be the outcome for another possibility. We call it Monte Carlo simulation. Actually, this one very interesting, but I cannot explain in details. If you are interested, you can go to watch the recorded video. All right, adjusted discount rate will be touching on this one. So if let's say the risk of this project is higher than the others, okay, even though you have all the expected cash flows, but maybe you know all the expected cash flows very hard to realize that one because many risks and uncertainties. Then one thing you can do to reflect the risk is to increase the discount rate. So because when you increase the discount rate, NPV will be lower to reflect the higher risk of this project. You can do that. Like initially your cost of capital is 10%. Okay, your cost of capital. But because of the risk, very high risk this project, you can increase to 13%. The 3% increase is not because of the cost increase. It's just because that you want to reflect the risk of this investment, so you increase 3%. And when this increase, NPV will be lower. Okay, so we have all these methods okay, to incorporate the risk inside the NPV, or like sensitivity analysis is not to incorporate. Sensitivity analysis is just to tell you which variable is the most sensitive one. You need to monitor closely. All right. I think that's all for the revision. And if you do not have any question, I think we can proceed to question 1. The group can get ready to present question 1. Question 2, I will let you all try that on the spot later because we have plenty of time today. I don't want to waste the time. Okay, Jing Xian is presenting.
So I will be presenting the questions once. First, the question asks us to find the net present value of this investment. So the first one to find is the incremental profit. The incremental profit is is 2 million and not yet to deduct the additional staff cost. So later we'll deduct the staff cost. So the profit will be happens in the first year of the operations. So maybe because the first year only start so the operating cash flow will be happens in the year end of the first year. Then can assume it's the second year, so it's the year and put at the year 2, and then the in
Oh,
the
okay, hold on, Chiping,
uh,
okay. A little bit wrong on your
uh,
explanation, okay. So it's not really, I mean, operationally, it's not really happening at the end of year one. Okay, this one will be starts at the beginning of year two, which means that second year. Because in this question, it's similar to last week that question. Okay, this question saying that we have 1 year setup period. Okay, so when we have 1 year setup period, it means that we can assume your year zero until year one now, okay? At the beginning of year one until the end of year one, that 1 year is for setup period one. So that's why your 0 to 1, you can see we do not have any operational things happens there. Okay. So whatever happened is after year one, which means that it's year two. So for the whole year two, at the beginning of year two until at the end of year two, you will have incremental profit of 2 million. Okay. It's because year one is the setup period. Okay, you may continue. Shipping, thank you.
so the incremental profit will increase 10% every year after the first year. So that will increase the year 3, year 4, year 5, year 6 till the end of the project. Then increase 10%, then the amount will come out. Then after that, the additional hiring of the staffs cost is the 0.2 millions per annum. So it's also incurred at the same after the first year of the also will increase by the 10% every year after the first year of the operation. So we also same like the incremental profit increase 10% every year. Then after that you use the incremental profit to minus the additional staff cost. You get the net profit of the amount, and then the taxations is 20%, 25% on the net profit. Then is the taxation also is paid at the same year with the cost and the profit incurred. So it will be at the year two. So 25% times the net profits will get the taxations, and there will also the capital allowance tax benefits. Scroll down a bit. Okay, the capital allowance is 25%, so we need to use the value of the new systems is total is 4 million. Then times 20%, we get 1 million of the capital allowance. Then minus it will become will get the written down value of 3 millions, and the tax allowance is for the capital allowance 25%. 1 times 25% is 0.25. Then just calculate that. Then the second year is the written down value is 3. Then do the same times 25%. Then we generate after the last year of the project. Then the capital allowance is not times the balancing figure, so it's 1.69 minus the capital allowance of 25%, 0.42 equals to the 1.727 millions, and minus the residual value, so it's the 0.5, so equal to the 0.77, and then the tax relief will be 0.77 times the 25%, 0.19, and the tax is also at the then you just put at the same year 0.2 scroll then put at the capital allowance tax benefit of 0.25 to the end of the project, year 6. Then the scrap value will be 0.3 at the year 1, because there will be the old equipment will be disposed at the scrap value of 300,000. So at year one, we'll add the scrap value 0.3 millions, and at the year end also will be 0.5 because the residual value, the end of the project will be residual value is 0.5 million. Then the investment, because the question says that there will be 2 equal annual installments. So the first payments must be due immediately. So at the year 0 must be already include this investment 2 million. And then the next year will be another 2 millions. And the working capital will where is the working capital? The one-time working capital investment of 1 million will be required when the system is become operational. The system will become operational at the year one. So will be included at the year one, and at the year end, year 6 will be recover back the working capital 1 million. Then like this, the total will be the net cash flows, and will be the amount you just all add together. Then next is how to find the discount factor. Is first you need to, because Tamari is not a listed company so need to for based on the proxy entities of the others proxy companies. So we use the others companies one. So we need to use ungeared of the proxy companies. So we need the BE is the beta of the liquidity is 0.78 and minus times the value of the equity is the 80%, because the debt to debt plus equity is 20%, so the equity will be 80%, and then divided by the 0.8, also the value of equity plus the value of the debt 0.2%, and times the 1 minus the corporate tax is 0.25, and the ungeared beta will be 0.66. And after we've ungeared that, and we put at, and we will gear our, and we will must find the geared beta. So the BE will be the 0 above we find one 0.66. Then this time is use our own company. So the value of the equity is 70%, 0.7, plus the value of the debt is the 30%, 0.3, times the 1 minus the corporate tax 25%, and divided the value of the equity, so 0.7, then equals to 0.87. This is our geared beta. So we must be our geared beta to calculate the cost of equity. So the risk-free rate is 0.0 is 3%, and plus the market risk premium 7% times the geared beta is 0.87. So we will be find our cost of equity 9%. So we got our cost of equity, we can calculate the WACC of our company. So the KE cost of equity will be 9%, 0.09, times the value of the equity is 0.7, plus the KD cost of debt is 0.05 after tax, as it mentioned in the questions. then times the 1 minus the corporate tax 0.25, then times again the 0.3 the value of the debt, and then divide the 0.7 plus 0.3 the total and we'll get the WACC of 8%. Then the discount that will be our discount factor 8%. Then use the net cash flows to times the discount factor, we get the amount of the present value. Then the net present value is the total of the present value from the year 0 to year 6. So it will be 3.111 millions. That's all.
Okay, very good. You explained everything clearly. I will just add on a little bit things okay, that I think worth mention from this question. So, okay, first of all, okay, like what I said, this question is similar to last week question 3. So this question, we have 1 year setup period. Okay, again, setup period is something like you want to build the plan, okay, you need to get everything ready. So first year, you do not really operate one. When I say do not operate, it means that you do not produce anything, okay, you are just setting up your equipment, okay, get ready your factory, all these things. Right, so as you can see, the cash flow there, 0 to 1. 0 to 1, the 0 and 1, it means that it's from now to year, at the end of year 1, there is no operational things happening. So, and if you read the question will tell you, right after that, we have 5 years of operations. So whenever you see that, you should know the 5 years of operation will be started from year 2, 3, 4, 5, 6, 5 years, from 2 to 6. Okay, so the question also very clear, like what Chipping has already explained, telling you that when you first year of operation, which means year 2, first year of operation, your incremental profit, nothing wrong because incremental profit is incremental cash flow concept, 2 million, and after year 1 of operation, every year increase 10%. So same applies to additional staff cost. This one nothing worth to mention. And then the taxation 25%. And this one, the question actually mentioned it, the taxation will be within the year. Within the year, it means that it's not 1 year in area. You can see the last 2 paragraph. Corporate tax is payable, blah, blah, blah. Tax is payable within the same year that it is incurred. So it means that whatever money you earn in that year, you pay tax in that year. So that's why you can see the 0.45 minus 0.45 is correct one within the year, 25%. Can you scroll down a bit, Jing Xian? Okay, yep. Okay, and then the tax benefits. Okay, this one actually the question mentioned is from year. If you read the questions, the capital allowance, it should be the longest paragraph, that one. Yeah, this one. Yeah. As you can see, it's already telling you that total cost of 4 million will be claimable as capital allowance at 25%, reducing balance, starting from the year when it becomes operational. So same thing, when it becomes operational, it means year 2 onward, until year 6, 5 years. Okay, so we and can you scroll down to look at your workings? Okay, you can use this working to calculate. Or I know you all have learned another method from another subject. Okay, if you feel that that method actually is shorter, if you feel that you are more comfortable with that method, go on with that method, go ahead. Okay, you do not need to really follow this one. All right, you get what I mean? Because I know that you all have learned how to calculate, the tax benefits by using other methods. So if you want to use that method, no problem, go on. Okay, use that in your final. I will be able to understand that. Just make sure that when you record the tax savings, you record correctly. All right, this one I don't think I need to explain. All of you should know how to calculate. Can you scroll up again? Thank you. All right, and then the scrap value, okay, that one nothing. Year 1, at the end of year 1, why we have 300,000 is because during the setup period, we are still using the old machine. So once we have completed, set up everything, the old machine no longer useful, so we sell the old machine first. So it happens at the end of year one. You cannot sell that. Previous student asked me, why this one not in year zero? You cannot sell immediately because now you still need to continue to do your business one, is that? So now you are using your old machine. And for the 1 year setup period, you still need to use the old machine one. It must be until at the end of setup period, everything done. You can use the new machine already. Then you sold you will sell the old machine for 300,000 there. Okay, and then the investment will be for the new machine. You need to pay 2 times, total 4 million. Working capital also nothing special at the end of year one. Okay, and then release at the end of year 6. Yep. This one student also asked me, previous class student also asked me, why your working capital not year 01? Very simple. Because during the setup period, usually we do not need working capital. I mean, when you are building the factory, all these things are setting up. Do you need to purchase raw material? No need. Usually it's when you start to, fully operate, start to produce that time, then you only need the working capital. So it happens at the end of year one. Okay, or you can think that it's at the beginning of year 2 when we record at there. All right, so nothing wrong on that. Okay, then net cash flow, then you have the discount factor 8%. You need to calculate yourself below. Okay, they have already calculated that. In the exam, maybe I will also ask you to calculate yourself. I mean, the discount rate will not be given directly sometimes. Sam, I will give you KD, KE, all these things, and then you calculate yourself for the discount factor. Like this discount factor is actually 7.85%. But no worry, if I come out this sort of question in exam, I guarantee you I will put a bracket to the nearest percentage. It means that if you calculate in the exam is 7.8%, then you just use 8%. Then you can apply the table. Because if I do not specifically mention that, maybe you will be thinking that, 7.8%, then I cannot use the table macam mana. I need to use formula to calculate. No worry, in the exam, I will put a bracket nearest to whatever percentage. So if you get 7.2, then you use 7%. If 7.7, then you use 8%. Okay? I can scroll down a bit. Anything else? I think nothing else. Ungearing, regearing, this one, you all have already done in the midterm. Nothing much to mention. Yep, I think that's all for the NPV. Thank you. You all may continue.
So for question B, calculate the sensitivity of the cost of the new system. So before we calculate the sensitivity, we need to calculate the present value of the cost of the new system. Because the question had mentioned that the cost is payable in 2 equal annual installments. Therefore, we need to calculate the present value separately. Then we sum up. So for year 0, the cost will be 2 million, and we times with the discount factor 1, we will get 2 for the present value. And year 1, we use the cost 2 million times 0.93, and we will get 1.85 million. So the total present value of the cost will be 3.85. And then for sensitivity, we need to use NPV divided by the PV of variable. So we use the net present value 3.1 million divided by the present value 3.85, and we will get 80.5%. So which means if the cost of the new system increase more than 80.5%, the net present value of the investment will become negative. And then for question C, recommend the appropriate investment decision. So since the investment show a positive NPV of 3.1 million, therefore the company should accept the proposed investment. And question D, advise Tamarin on 2 non-financial factors that should be considered before making the final decision. So the first non-financial factor that should be considered is availability of manpower. So Tamarin need to make sure that there is enough manpower to operate the new system to be invested in. And the second non-financial factor that should be considered is government regulation. So Tamari need to consider the government relevant laws such as Personal Data Protection Act 2010 before making investment appraisal. So that's all.
Okay, can you show me the answer again? Yes, this one. Okay, so first of all, the sensitivity analysis, no issue on that. Okay, everything's correct. Like what Jen Xian said, and like what I said just now, remember the presence NPV, usually you have already calculated that one. Okay, but when you want to divide it by presence value of any variable, remember you need to refer to the row, the timing. Like this is the, for the cost of new system, 2 million, 2 million. But you know, the 2 million, 2 million that happens at different timing. One at year 0, there was no problem, it's already present value. Another is at year 1. So you need to convert year 1 to year 0 to find the present value. So it's 80.5%. All right, and then the explanation also correct. If the cost of the new system increases more than 80.5%, NPV will become negative. Perfect answer. Okay, over there. And this one I would say that it's not very sensitive lah. Okay, because 80.5% it means it can difference 80.5%, you know. At the end, the actual outcome, it can difference up to 80.5%. Your NPV still actually positive. So it's not that sensitive lah, this item, I would say. Okay, and then for the C, just asking you to recommend an appropriate investment decision. So because positive 3.1 million, so we should accept the proposed investment. That's great. Okay, and for donkey, this one definitely is your own answer lah, different from former answer, but very, very good. Okay, I mean, if in the final I test you on 2 non-financial factors, you include these 2, I will give you full marks. Okay, very good. You talk about availability of manpower. Usually, if you are talking about your resources, talents, will be non-financial factors. You must also consider that. Not only, you know, talking about NPV financially acceptable, but I mean all the non-financial factors, you must also consider that. The manpower, do you have the talents to implement this project? All these things will be non-financial factors. And I also like your answer on the government regulations, because actually this one is talking about a new system. Okay, you computerized systems on tracking the orders, all these things, which maybe involve the sensitive data, confidential data from your customers or from the suppliers. So here you're talking about PDA, okay, PDPA, which is good. Okay, I think nothing wrong on that. If I were the marker, I will give you full marks on that also. Very good. Okay, just that I want to ask you all one more question. If let's say I ask you all for the C, that one, I change the question to discuss the answer calculated in A, 6 marks. Okay, what else can you talk about this question? I repeat, all of you try to answer this question because it could be in your final, I can tell you. I like to ask this kind of question. So if last week I told you all, if let's say I only ask you 2 marks, like this question, 2 marks, recommend an appropriate investment decision based on what you have calculated. NPV positive, so accept lor. Maximize shareholders wealth, full stop, 2 marks. You score all the 2 marks. But if you look at the question asking you to discuss the answer calculated in A, which is your NPV, positive 3.1 million, ask you to discuss the figure. Of course, you will say positive, accept, but I will only give you 2 marks. And if the question 6 marks, what can you say? I mean further, elaborate further for this kind of question. Think about that. I give you 2 minutes. What else can you talk about that? It could be a question in the final. Because like what I said, NPV is a guaranteed to come out question. So not only calculation, I like to ask all those like theory question to test you on your understanding. So what else you can say? It's not from the former answer, this one. It's just that I personally add the question. Very good, Shipping. Okay, you can talk about the weakness of the MPV method. So definitely you can score one. This one is a very general answer, but you always can score based on that. You can talk about, oh, yeah, it's positive, but we also need to be careful on the weaknesses or limitation of MPV, such as, all the cash flow, there are expected cash flow, so might not be accurate in the future. So you may also suggest maybe we can perform some risk measurement methods, like probability analysis, or whatever simulation, okay, to minimize the risk. Definitely you score 100%, I can tell you. The general suggestions for that. Okay, and I give you one more. Actually, one more problem here will be what I see here. You can see because the questions, the last paragraph, okay, the last paragraph saying that this company is not a public listed company, so that it does not have its own KE one, so in order to find the KE just now, like what you all have done, you all use the project specific KE by using the others listed company equity beta. From there, you ungear, regear to find the KE out, and then check that this one we can use that for our company. But actually, it is still not perfect. Okay, why? Because if you have learned, you are not a public listed company. Now you are using the proxy of a public listed company, even though same business risk, but is it appropriate? Question mark. You can also talk about that. I can tell you at a higher level paper, it's always this kind of question. You need to find the answers from the question and apply some financial. I mean, whatever you have learned from this subject, financial management, you can show your understanding one. That's how you can score. What just now Chipping answer is also very good. When you're talking about weaknesses, limitations of MPV, is something that you have learned from the syllabus. So we apply that saying that, this one we need to be careful, which is correct. Okay, very good on that. I think that's all for question 1. Thank you. Yeah, and then one more thing, the non-financial factors, it could be anything. You will have the formal answer later. You can also talk about from the formal answer, competitiveness. Okay. You can also talk about can you managing the efficiency in the operation. This one I think is same with like the manpower. Do you have the talents to use the methods, all these things? Use the new system, sorry. Okay, and then third, okay, over there saying that if you use the methods, you can save some fuel cost. You don't need to use so many fuel. So it's like environmentally responsible. It's also non-financial factor. It's just saying that because as a company, we need to be, socially responsible to everything, to the environment also. So if we use this system, we can, use less fuel, okay, then it's actually something good for the environment. It's something that you can consider also, not only financially or like talk about profit only, but also the other things. Okay, so all right, so right now, like what I said, question 2 is a very simple question, I can tell you. Okay, and since today we have a lot of times, I also don't want to waste the time, we fully utilize them. Okay, so for this question, I want all of you to try that on the spot. Only A and B I give you about half an hour, because usually you do not have a chance to try it yourself. And trust me, I won't waste your time when I ask you, like what I said, it's a guaranteed to come out question. MPV, capital budgeting, okay. So since today we have some time, so please try that. Half an hour definitely more than enough for you to get these 2 answers from this question. At least you practice one simple question. I can tell final will be way tougher. Final will be tougher than this one. So you can treat this one as a practice. Okay? You can ask me any question when you are doing that. I will mute myself first, but you can ask me. You can ask me question via the chat box or you can unmute yourself. All right. I will give you about 25 to 30 minutes. Then I will show you the formal answer. All of you, please try. Don't waste the time. Okay. Alright, so I think I will show you the answers first before I actually go into the discussions. Because I hope that you have already done that. You all can double check your answer first before I explain further on this question. Question and answer. Alright, I will give you a few minutes for that. Make sure you have all the figures placed correctly, okay? To get the answer MPV. Some of you might get 104, I'm not sure, because the previous class students told me, some of them that got 104,000 something. Probably it's because of the decimal point. Okay, I'll give you a few minutes for that. It's basically quite a simple question, I would say, for this one, because you can see at the end, it ignores the capital allowances and also the inflation. Okay, of course, the NPV for the IRR calculation, you can use, I think you can use 16%, also should be able to get the answer. Okay, so I think I will just quickly go through this question. Alright, so nothing special. If you read through, okay, basically some little tips lah. Usually when you see this one, the company pays the profit tax 1 year in areas, okay, at an annual rate of 30% per year. When you see 1 year in area, then usually you will know that even though this one is a 5 years project, but when you draw the table, it's going to be until year 6 because of the 1 year in area taxation. Just a little bit tips here lah, okay. So through practice you will know usually. Okay, and nothing special on sales revenues. Every year 100,000 times 16, so it's 1.6 million every year. Variable cost 11 per unit, and also 100,000 every year, so 1.1 million every year. After you minus, you have the contribution minus the fixed cost every year, 160,000, and you have the taxable cash flows, and right after that will be the tax liabilities, 30%, 1 year in area. Okay, 1 year later. In here, just now in question 1, I forget to actually talk about this very, very, very important thing. All of you listen carefully. Common mistake from students. Remember, your taxations will be applied to taxable cash flows only. When we say taxable cash flow, it means that those cash flows that are like profits, your operational cash flow, okay, which will be subject to taxations, like it's really is your gain. And you will notice the tax liabilities will be always before anything like working capital, initial investment when you purchase the machine or factory, something like that, and the scrap value. Okay, so all of these, like what you see, you spend 90,000 to purchase working capital, you spend 800,000 to purchase the machine. All of these, and including the scrap value, they are non-taxable items. I think as an accounting student, you definitely know, because when you are selling we assume that you sell at the net book value, the scrap value. So the scrap value is like 40,000. So your net book value 40,000. At the end you sell 40,000. Is there any gain or loss? There is no gain, no loss. Even though you receive back the 40,000, but there is no gain or loss in this transaction. So that's why this 40,000 is not taxable one. Common mistake from students, from your seniors, which I have seen, everything that do first, including, I mean that before taxation, they also include working capital, scrap value, investment cost, everything above. Then all the things subjected to the tax, which actually is wrong. All right, remember this thing. Same applies to question 1 just now, you can see. Okay, so definitely you see the tax will be here, can you see? Taxation will be based on your, usually will be only based on your operating cash flows, if you want to say. From some things that you can make profit, profit minus all the expenses. But when it comes to like purchase of assets, all these things they will not be subjected to these taxations. How many percent? 25%, 30% will not be subjected for that. I know some of you definitely understand that, but just in case that some of you could make a mistake, okay, if I did not mention that in the final. So remember, for items, like you just purely cash basis, buy asset, sell asset, there is no profit and loss in between one. That's why we just record after the taxation, they are not taxable. All right, and then after that, nothing. We have the net cash flow discount factor. All right, very simple. And then we will have the NPV. Okay, and remember one thing for the IRR, you really need to try it one time, okay, then you will know your problems. So IRR, like last week what I told you, your discount rate is basically a cost. So initially your cost 11%. When your cost 11%, you get positive NPV. When you want to calculate IRR, you want negative NPV, so it means that you want to reduce the value of your investment by increasing the cost, your cost of capital, your discount rate. So like what I said, plus minus 5%. In this case, it's plus because you want to increase the cost. You can use 15%, you can use 16%, 17%, or even 20% if you want, as long as you can get a negative NPV. So you have one pour, one net, two discount rates, 11% and 17%. Then you can apply the formula, interpolation method, and you will get the IRR. Okay. Or like what I said, if you really don't understand the concept, very simple one way to remember, should you add or minus, you look at your NPV only. If your NPV is positive, add 5%. If your NPV you get is negative, minus 5%. It means that if you use 11%, you get minus 103. If your NPV is negative, so another rate you use 6%, minus the percentage. If positive, plus the percentage. Simple to memorize. Is that? But I hope that you understand the concept behind. All right, and then C just asking you to explain sensitivity analysis. I have already explained that at the beginning of this class. And to calculate the sensitivity on two variables, first is the after-tax sales revenue. This one is after tax. So that's why first of all we need to calculate, because we know from the cash flow, this one will be the sales revenue from year 1 to year 5. Can you see every year happening? And we want present value, so we just times the annuity table. Annuity table A4, 5 years. This one. So it's 1.6 million every year, if you can see. 1.6 million every year, and we times the 5 years 11%. We can get the present value of the sales revenue, which is this row. This row. We convert this row 1.6 million to a present value. Okay, because it's annuity, we can use table A4. 5 years, 11%. You will get this figure. Okay, but we are looking for after tax, as you can see, after tax sales revenue. So we need to calculate the tax arising from this sales revenue, because sales revenue basically is profit, is that? So that's why we use the 1.6 million times 30% tax. It means that will be 480,000 every year. From the 1.6 million, every year is 480,000. But the problem is, as you know just now, the tax is 1 year in arrears. So which means that this 480,000, it happens from year 2 to year 6. This one, from year 2 to year 6 one, because 1 year in area, your tax. So now your job is to convert this every year one cash flow, the tax, okay, to a present value. How to do that is still an annuity. So we use 480,000 times. How to get this figure? We learned that last week actually. I repeat, pretty simple. So now we know it's an annuity, is that? Annuity, but we want year 2 to year 6 only 11%. So we come to table A4, 11%, year 2 to year 6. Okay, so never mind, we take the 6 years first. So this 4.2305 is from year 1 to year 6 every year, every year the annuity from year 1 to year 6. But we only want year 2 to year 6 because the tax is 1 year in the area for 5 years. So we just use this figure, 4.231, just now from the answer. We minus this one, 0.901. That's how we get the figure, this one and this one. Okay, for this one. So it's an annuity that's showing you from year 2 to year 6, the present value of the tax, okay, arising from the sales revenue. So after tax present value of sales revenue, very simple. We just use the present value just now, the sales one, minus the taxation. So it's the after tax present value of the sales revenue. And use the NPV just now divided by this figure is 2.4% sensitivity from the sensitivity analysis. So if you want to expand, it's very sensitive for this one, I would say. Anything below 10% for me is quite sensitive already. 2.4% is very sensitive. It means this item, if it changes for only 2.4%, then your NPV will become 0. So it's very sensitive. If it drops more than 2.4%, your NPV will become negative. So very sensitive. While the discount rate sensitivity, this one from the IRR, this one a little bit special. We are not using the normal formula. But as you understand, actually the formula is talking about how many percent changes will make the NPV become 0. So actually same thing here. Our discount rate cost of capital is 11%. And we know from the IRR just now, 16% NPV will become 0. So from 11 to 16%, okay, from 11, if it increases to 16%, NPV will be 0. So the difference is 5%. So, okay, the cost of capital. But proportionally, 5 divided by 11 is actually 45%, which is not that sensitive for me. Because this one, you can say that the discount rate, even if it increases in terms of proportionally, it increases. Actually quite confusing because I'm using 5% and then 45% again. But I hope you understand. 5% is referring to the cost of capital. It increases 5%. Okay? But proportionally from 11 increase to 16, 11 to 16, proportionally is 45% increase. So it means that it's not that sensitive actually. Okay, for this item, for this variable. Alright, so in here we will still say that if we make a conclusion, the present value of the after tax present value of sales revenue is more sensitive than the discount rate. Alright. That's what you will sometimes see in the final exam. After the NPV IRR, they will ask you to calculate sensitivity analysis. It's together with the NPV question. Okay, if you do not have any other question, if you have any other question, you can ask me. If you do not have any question, I will spend some time to talk about your midterm. You can take out your midterm mark paper, okay, to match with the answer, see which part you make a mistake. And if you notice something's wrong, you can ask me on the spot later, okay? Or if you feel shy because you don't want to show your answer one, also never mind, you can PM me later because I'm also human. So I could make a mistake or I could overlook something one. Maybe supposingly you get the mark there one and then I overlook that, miss one mark. So if you see something like that, you can come back to me later. So this is the formal answer. All right, I will go through slowly so you all can see the answer. Okay, and I will pick up some mistake you all have made. But for your group, basically okay I would say like what I said, I meet my expectation. I think 30-40% score A. So it's pretty good already actually, I would say. Okay, so this one I think most of you get the answer. Okay, cost of equity, I think most of you can get 9%, so not a huge problem. KE, okay, 15.2%, most of you can get. Just that some of you, I do not know why when you apply the formula, you forget to add the G. The formula is D1 divided by the PO plus G. Some of you forget the G here and become 6% something. Okay, so you are losing mark here. But I think some of you notice, and I think I told you all these things before. Like if here you are wrong, definitely you are losing the marks because you record as a 6% mindset. But later on, like C, WACC, you are going to use back this figure. Alright? So if let's say C, you use the 6%, that's what you have calculated, at A. I will give you full marks on this one. Okay, I will give you full marks on that. Okay, it should be independent one. That's our way to mark the final exam, the final e-assessment also the same. It won't be like this one wrong and then below all wrong. No such thing one. Question by question is independent to each other. It means that if this one you are wrong, of course you will be penalized, losing the mark. But if you use this answer you apply to the following question now, okay, that one is correct one. I will assume that because this is the KE you have calculated, and when come to here, you use back 6%, KE calculate totally different WACC, but you will see I give you full marks there one. A lot of you, quite a number of you. So don't be surprised, it's not that I mark wrongly. It's because if your workings, everything correct, I will give you mark. Okay, you will not be penalized in another question for that. All right, and then the cost of that, okay, this one also I think most of you can get the answer. Just that some of you, I do not know why, using the irredeemable formula, then so sorry totally wrong. Okay, but if you show me 6, I still give you 1 mark sometimes. Okay, because this one, if you remember, I explained many times, it's a redeemable bond. 5 years from the question, 5 years to maturity. So you should know that redeemable only one way to find the KD, which is going to be the interpolation method. All right, you can use 5, 8, you can use, some of you use 3%, 13%, some of you use 5%, 10%, up to you. The answer will be a little bit different. If you use, I think 3 and 13, you find 5.4, something like that. It's also correct. Because like what I said, interpolation method is not perfect one. If you use different rate, you get different answer. As long as your workings, everything correct, you score the full marks here. All right. And for C, supposedly this is the correct answer because if you read the question, the share in issues is in terms of amount, as in issue 8 million ordinary shares. Okay, so 8 million shares we are having. GNB has in issue RM 0.06 million. It means that it's in terms of amount, okay? It's not the number of shares. Most of you saw it correctly, actually in your class, no problem. Okay, so this is the answer. In some students actually that think that is the number of shares, I also close one eyes. This one I added later on one. So if you think that is the number of shares, you will get something like that, which again I also give you correct. Okay, all right, so either one. I think most of you will get this answer. But remember one thing, this one, it should be 0.0624. Some of you just use 0.06. That one definitely is a par value. From the question, the market value is 104 per 100. So that's why you must times accordingly. When we calculate the WACC, you look at the tutorial question, look at the lecture notes, we always use market value to calculate. So if this one you use 0.06, so sorry, wrong. All right. If I'm too fast, you can let me know. Or later on, you want me to show you which answer, you can tell me. Okay, and donkey, this one also most of you can score, which is pretty good. All right, because for donkey, it's already many times. Okay, so these questions, if you read, your company is GNB, it's a fast food company. Now your company wants to take over another company, IGG, which is a pharmaceutical company. All right. So at the beginning, as you can see, ABC, I'm just asking you to calculate your current WACC. So nothing wrong. You apply whatever. Okay. Information given there, you calculate the WACC, 15.13%, I think. Okay. But when come to donkey, I'm actually asking you. So now you have the current WACC of your company doing fast food business is 15%, let's say. It discuss whether is it appropriate to use this 15% as a discount rate for this new project, talking about acquisitions of this pharmaceutical company. Is it appropriate? The answer definitely is not appropriate, because I explained many times before, the project specific cost of capital, okay? Now, your current WACC, what you have calculated, it is based on your existing business risk and your financial risk. When now you are going to talk about you want to, take over a new company which is doing totally different business, okay? You want to calculate the NPV, something like that. Can you still use back your current WACC? Cannot, definitely. You need to use the project specific cost of capital. So this one, I'm just asking you, can you use back? The answer definitely is cannot. So you must tell me why cannot. Actually, very simple. I've explained that before. Because different business risk, different financial risk, and the size is also different. Okay, so if you explain the three, I will give you marks accordingly. Then after that, I only ask you to calculate the project specific cost of equity for that project. Okay, so this one, I think most of you can get the answer also, which is pretty good for you. For yours will be this one. Or if you are using this 6.241, then will be this one. So there will be two answers. Either 8.94 or 11.38. Nearby the answer, because sometimes your like what I said, some of you, your KD is a little bit different, 5.4%. It's also correct one. So I will check properly. But some of you wrong is because of this one. I noticed here. Some of you I deduct marks. Even some of you, your answer is 8.91%. Okay, but you are wrong because your when you apply this one, the VE, you are using the VE plus VD. You are using 9.4 something. Which is wrong because you follow the formula is VE only. When you V-gear, it's only VE. Some of the students use 9.4 something, 9.42. So their answer will be 8.911. When I recheck, I noticed something's wrong there. So your mark will be deducted accordingly. You will probably only get 1 mark here. Okay. And F, I have to admit, this one is the toughest question. It's quite tough, but I have explained that before also in the class. Okay. So what is F? F is actually I'm asking you, even though now we are using because like donkey, we understand already, it's different business. So that's why we need to use a project specific cost of equity. We cannot use the current WACC one. So F is actually asking you, even now you are using project specific cost of equity, okay? But it doesn't mean that it is 100% a correct one. So what will be the two potential problems if you are using this project-specific cost of equity? Okay, and discuss the implications. I think this one, not many of you can score very good. I will show you the formal answer. Okay, I think none of you able to tell me this one. All right, in order to look for the one more thing, just now that one is 1.3, the proxy equity. Some of you use 1.08. So sorry, I purposely include few one in here. As you can see, I purposely give you 1.3 for the pharmaceutical company one, public listed company. Okay, and then the GNP. Okay, and also the average equity beta of this public listed fast food company 1.08. Some of you use this figure, but as you understand, when you are choosing the equity beta, okay, now you are going to use the business risk of the pharmaceutical company. Definitely is this one. You won't be using your own equity beta or the average industry of the public listed fast food companies one. That one is still fast food business. What we want is what is the business risk of the pharmaceutical company. So this one is the correct one, 1.3. All right. And okay, so now we use 1.3. But the first problem, I think none of you noticed this problem. Now you are talking about the project of this company. And this company is, because you want the business risk of this company to reflect the business risk of this company. The business risk of this company is a Sendrian Berhad. But when you use the proxy beta, the closest one is definitely this pharmaceutical company. But this one is for public listed one. So that's why the first problem you can mention is the what we call the proxy equity beta might not be 100% accurate law, because actually we are talking about private limited company, but the equity beta we are using is pharmaceutical company one, but it's a public listed company. So maybe we have something's wrong. And another thing you can talk about potential problems is not perfect one, even though you are using this method, because if you remember, I explained in the lecture class, this project specific cost of equity is also from CAPM model. CAPM model, we are using beta, we only assess the systematic risk. And this model actually assumes the market is perfect, assuming no taxation, all these things. So we have a lot of unrealistic assumption. So might not be a great one, even though we are using this percentage also. Okay? And the implications, you can talk about if you are using this or this, if you lead to a lower percentage, all these things. Because here you can talk about, because the equity 1.3 is higher, is that? So when this one is higher than initially your company one is 1.08 and this one is 1.3. Correct? So it means that pharmaceutical company is higher risk if you actually increase if you following CAPM, if you actually increase the WACC after the acquisition, if you follow CAPM model, okay, due to higher business risk of the pharmaceutical company. However, if you diverse your business, then maybe a better diversification could be achieved, which will reduce the risk. So at the end, we also do not know the risk will increase or decrease. It depends on the risk perspective of the shareholders. This one will be a little bit tougher for you to score. Only this question, I would say. All right, or you can give me other implications. I will also give you marks accordingly one. That's why you can score also. All right, and then for G, this one actually is a very simple question, but some of you cannot score. I do not know why. You look at I told you all, if you are talking about the dividend policy, you just look at the earnings per share, dividend per share, and from there you will see it is increasing every year, while the earnings per share is remaining. You can talk about the company is increasing its dividend per share every year. Okay, I will give you 1 or 2 marks already, and then you need to talk me about pros and cons. Just a sentence. Actually, my former answer is increasing. The company is paying increasing dividend per share, but actually the earnings per share is there any increment? No, which means that it could be a problem sustainability. If you continue to increase but your earnings does not increase, you cannot sustain one in the future. That's my former answer. But of course, a lot of you also score full marks because, like what I said, up to you. If you want to say increase is good, can attract investors, I also give you marks accordingly. All right, unless you left it blank that one, or unless you tell me, some of you, I do not know why you follow the tutorial answer. I think pute follow. You just talk about it's a constant fixed dividend policy. The company paying a constant dividend payout. Definitely, it's not constant. This one increasing. That one, so sorry, you'll be losing marks. Okay, because your answer is wrong. But as long as if you are telling me it's growing or increasing, and with some explanation talking about goods and bads on this dividend policy, then I will give you marks accordingly. All right. That's for the question 1. So for question 2, this one I think most of you can get the answer 902250. I just don't understand why some of you use 50 times 50. I don't understand where do you get the 50 from. This one, the PE from the question, very obvious, is 50 times already and times exactly the same with your tutorial question. If you look at the question, this one exactly the same. I remember we have one tutorial question. The post-tax profit is the after-tax profit, 45 million assumed to be received in cash. Exactly the same with your tutorial question. But somehow I do not know why some students, quite a number of them, they use 50 times 50 million. I also do not know where's the 50 million coming from. Maybe they think that is the number of shares, but it's not number of shares, the formula. It's the net profit after taxation, which is the post-tax profit from the question. Okay, it's this answer. And then this one, I think most of you also can get the answer. Very simple. Right, you just use the total dividend, constant every year 80 cents per share, and then we have 50 million shares from the question divided by the KE. So you get the answer. And for the discounted cash flow model, actually, I think most of you can get the answer quite good. Just again, I do not know why some of you started with 50 million. Okay, quite a number of you. I also do not know where's the 50 million coming from. Cash flow. Okay, it's a cash flow. Assume the question already given you, assume to be received in cash. So this 45 million. It should be started with 45 million here. But I'm so nice, even you use 50 something, I still give you, I think, 2 or 2.5 marks for the format. Because the students, actually, some of the students, they have done everything correctly. It's just that I do not know why you're using 50 here. Okay, so I give you some marks also for the format. You will see I put a format there, 2 marks or 2.5 marks. All right. And then this one, you are lucky enough. Okay, I try not to be picky. As long as you explain, I give you marks. Actually, I'm trying to be picky at the beginning one, but like what I said, okay, I remark actually. At the beginning, if you just tell me something like that, I give you 1.5 only, because actually like net assets value, I'm hoping to see some of you able to mention is not suitable. Why? Because net asset value, if you remember, I said it's more for a company with a lot of physical assets. But in this question, the company is a technology company. And you know, technology company, the value derived from the copyrights, patents, their software one. So definitely it's not suitable. Actually, I'm looking for this answer. It's not very suitable as this one is a technology company, which is value mainly derived from its patented software, but not tangible assets. Initially, you must have this one in order to score 3 marks. But like what I said, I just give you if you explain something like this one does until here, I also give you marks. Okay, so most of you can get very close to full marks here. And then C, okay, C very simple huh? You can use similar to the tutorial question, this one exactly the same, initial asking price. Now you are from the company, so you can recommend, but when you recommend, definitely you do not go to the lowest huh? For those who use this one and this one, so sorry, you will score a very low marks. I give you the reason why. First, if you understand here, you should understand a technology company, we should not use net asset value methods because we are a technology company. And this one is the lowest value, 90 million. You try to ask yourself, if you are from the company, now you want to sell your company out, will you use the lowest price to sell your company out using the net asset value method? You won't. So for the student who recommend this one, so sorry, maybe you can only score 0.5 out of 4. All right, PE no problem. If you can explain premium 3 to 4 marks, I will give you. This one also, some of you use dividend variation model. In the above, here you already mentioned, if you remember, the dividend variation model only can use for variation for minority shareholdings. You want to purchase 5%, 10% shareholdings, you can use this method. Because if more than 50%, then everything will change. BOD will change, your board of directors will change with the new management coming in. Then you cannot guarantee that your dividend policy can still follow paying the fixed dividend every year. So that's why it's no longer relevant. I think almost all of you has mentioned this one. It's not relevant because the company shares are being considered for sales right now. Take over case in this case, definitely more than 50%. Somehow, some of you write like that here, but below, you all suggest using dividend variation model. So sorry if you use this one, you will score a very low marks. Okay. For all the others, if you recommend PE or cash flow methods, you will score a pretty good marks here. All right, you must include the figures because asking you the fair share price. Okay, and Donkey, the last one, I do not know why some of you left it blank. Actually, it's a very simple question. It's similar to this one. Okay, the purpose I ask you, it is just see here, it could be because if you are CFO, you could be a little bit biased. When you offer the initial selling price, usually you offer a higher price for them to cover the offer. Understand what I mean? Because now you are the CFO of this company, you are going to sell your company out. Definitely when you offer the price, you offer higher price. All right, because you are from the company. So Donkey, the answer I'm looking for is actually, I'm just asking you, how about if you are an independent person or outsider, you are not from the company, not from this transaction, if you were to give a fair price, so what do you think will be the fair price? You also select from here only. It's either PE or cash flow methods. But my former answer, actually I'm looking to, you can explain something like, if I were to be an outsider, okay, so maybe I will not offer so high price. Because this one is only a Sendirian Berhad, it's not the proxy we are using. Like if we are using PE, you understand that we are using PE of a public listed, but now the company is a private listed, so maybe I will have a discount of 20 to 25% if I were to be an outsider. Will be lower, okay, to be fair. That's the answer I'm looking for. But again, if you explain the other with justification, I also give you marks. All right, I think that's all. Also have no time for you to ask questions already. Okay, and like what I said, okay, if from just now the answer, anyone unable to see any, just now I should not close. If you're unable to follow one, I can still show you the answer, no problem on that. And if you have any questions, like if you look at your mark paper and the former answer, suppose I should be able to score this one. Why losing mark one? You have question, you can PM me. I will recheck that your mark paper. Because like what I said, I have yet to key in one in the intranet. Because it could be a human error one, so you double check yourself. Any question? But for your group, I think pretty well. You have done pretty well. A lot of you also score A. Okay, if you have no question, I think that's all for today. I will see you all in the lecture class. Again, if you have a question, you PM me. All right. Okay, bye bye. Nothing.